Manish Sonthalia, welcome back. Thank you for joining us. How are you dealing with this kind of an market volatility, Manish? On one side, you've got a promise that good companies will make a comeback, but on the other side, you've got serious price erosion in Eicher or perhaps the Page Industries or in Asian Paints. Since you focus on quality at reasonable price, that theme for the moment is getting challenged.
Yeah, so we will have to live through this journey. And there are no shortcuts, and you don't change your strategies when the mood of the market changes. It's as simple as that. So, if the long-term trajectory on earnings on these companies remain perfectly intact, and if you are not seeing a sector rotation, a major sector rotation, right? And that major sector rotation is the capex cycle picking up. The valuations aren't going to fall because there's simply too much of capital to be deployed. And when stocks are cheap, they are cheap for a reason, and we have seen many of these names lose 70, 80, 90% of the market cap on the garb of they being cheap. So it's better to buy quality, provided you understand the business, and the free cash flow generation ability on these businesses for long periods of time, and one will have to live through the volatility. I don't think changing strategies would really work.
But my question is that when you see a disruptive change in a company like Eicher, a year ago, year and a half ago, I never thought that the business will slow down that much, but it is slowing down. If a quality company which has got excellent cash flow, if that also corrects by 30-35%, it just makes you wonder.
No, the whole point is that if the stock has gone up from, let's say, a 300-400 rupees to 32,000 rupees, and it has come down to 20,000 rupees, and now the valuations are 20 times 1 year forward numbers, and all these years the valuations were 40 times, 50 times 1 year forward numbers. The move from 500 to 20,000 rupees has got established, right? And of course it went to 32 and has come down to 20. But is it cast in stone that the volumes are not going to cross 60,000 now forever? I wouldn't believe so. 9,25,000 guidance, obviously due to reasons like insurance hikes, like your ABS transition, like your BS transition. These would have an impact on the cost price, and that is having an impact on the demand. Of course, these would be temporary, I would believe, because you have a very strong marriage season this year, and of course UP is one of the very big new markets for Eicher which is coming in. So I would tend to believe that even if, let's say, you see a degrowth for Eicher this year, of course if you look at FY21, I would still believe that a 15% type volume growth is very much doable. And this without taking into perspective anything on the export front. Nothing really is happening on the export front. So valuations have come down. The stock has now moved from 500 to 20,000. Let's assume that. At 20 times 1 year forward numbers, you can't really argue that the valuations are expensive. The journey from 500 to 20,000 appeared that the valuations were very expensive. Of course, it went to 32. That has seen a correction of 35%. But from here on, if the 15% growth comes through, then you will see a slow and steady up move in Eicher. That is how I would believe. This Java, success of Java or failure of 650cc launched by the company. It's too early to call it either way. And you would require 6 months of time frame to really gauge whether a product has really succeeded or failed. So the initial euphoria is always there when a new product is launched. So I would rather hesitate to call it quits for Eicher for the time being.
But Manish, for the shorter term investor, it's really a game of patience. When you have other names in the market giving you that kind of return and visibility, more so in uncertain times like these for, say, the next year, year and a half, why would you put your money into Eicher? What's the time frame when you see that a meaningful growth visibility would come back for Eicher? Because right now, clearly that's a miss.
There's nothing called short-term investing. So, it's always short-term trading.
Years.
So, Yeah, I understand that. But let's assume that somebody is looking at the next 1.5 to 2 years. Even buying at these prices should make you money in these levels. But I mean, if anything very significantly different can happen between now and the next 6 months, I mean, a lot of it which will be dependent on how this whole, money into the rural parts of the economy flows through, because we are also looking at an election year. So all of these things are ifs and buts for the short term. But definitely, once all these transition measures, that we'll be operating in, the insurance hikes, the ABS transition and the BS transition, it's not that the journey for motorcycles in terms of volume growth is over. Of course, 11-12% volume growth over the last decade will weigh down to something like 7% and within that, this 350cc plus segment definitely has some room. Of course, there is going to be increased competition, but it's a story still evolving. I mean, I wouldn't believe that Eicher is done with. I would believe that just a stop in a long journey ahead for us. But there are no shortcuts for the next 6-9 months. If one wants to flip through for the next 6-9 months, of course, he or she may be free to do so. But you can get out, but nobody is going to tell you when to get in, and you will only realize that in hindsight that the price would have moved up and you would have exited at a lower price.
Manish, give us your sense. You're saying that no margin hit on fuel sales for oil marketing companies. What is your view largely on the oil and gas sector?
So they are making some very decent margins on the marketing side now, but this 1 rupee cess absorption or 1 rupee duty absorption has taken the faith away from all oil marketing companies. In terms of P/D rating, what we have seen, the amount of market capitalization loss that one has seen in the oil and gas sector is not funny. I mean, it was just 1 rupee, and that too for a few days, and that has eroded close to 2 lakh crores worth of market from the state-owned oil marketing companies. Of course, coming to fundamentals, there is deep value. I mean, there is no doubt about it. You're trading at valuations of 1-time price to book, right? And maybe 3, 4, 5, at best 6 times price to earning, depending on how much of inventory losses come through on account of the crude correction as well as the forex impact. But I mean, I would tend to believe that companies like HPCL etc. would make something between 5,500 odd crores, everything said and done, for the next 3 years at least. And then you are looking at a capex for all the oil marketing companies. So I mean, net I would want to believe that there is some very deep value in oil marketing companies, but sentiments have got soured purely on account of PD rating, sorry, and it would take some time for the P to re-rate. I mean, there has to be an assurance coming from the government side on this front, because investors don't want to believe this. I mean, this whole confusion about decontrol and control was just because of that 1 rupee duty absorption that was forced on oil marketing companies for just a couple of days. And then you had the oil really tank, and they are now making some supernormal margins on the marketing side. But the damage has been done. Fundamentals are perfectly intact.
Manish, what about financials? The general consensus view is that you should now buy corporate banks. They have CASA, they have money to lend. Retail banks are expensive, consumer is slowing down, NPA delinquency will start. So would you buy this popular consensus, at least popular consensus brokerage view that buy corporate banks, they are cheap?
No, I would believe this, and in fact we have bought ICICI Bank in our portfolio. We have taken money off Bajaj Finance. This is an environment where banks will be at an advantage over, let's say, non-banking finance companies. And obviously you are right when you are saying that the retail focused banks has really done very well over the last few years. They may go through time correction, there's nothing wrong with that, but even the corporate banks that we talk about, the Axis banks of the world or the ICICI banks of the world, 40-50% of their book is still retail. And I am of the firm belief that corporate NPA cycle has peaked, and valuations are 1.5 times price to book for ICICI Bank. And remember that they have some invaluable subsidiaries with them. The life insurance business of ICICI or the general insurance business of ICICI Bank. I mean, insurance is an infinite ROE business. You require capital for a period of 10 years, and after that it's a free cash flow machine forever. And if you have the core banking book start to revive, and this you are getting at 1.5 times price to book, it's certainly better than a Bajaj Finance at 6 times price to book, where 40% growth is not to come. I mean, we have seen all that era that Bajaj Finance has seen over the last 10 years. But I think growth rates are going to be something like 20-25%. This is what the management itself is guiding. And for that to pay up 6 times price to book and a 40p seems slightly out of sync. So there's definitely a case for corporate banks. We have incorporated one of them in our portfolio.
Manish, 2018 what we saw was that there was a bit of a macro risk. Large cap stocks managed to outperform, but a select few only did well, whether it's TCS or Reliance, to a large extent HUL. Now that macro fears have receded, how do you think the general mood will change?
I think 2019 is going to be a year of the emerging markets, right? Everybody is fixated on a growth in a trade war environment between US and China, you know. So whenever, and whether it be the US Fed, who is now starting to sound very dovish, or you're talking about, let's say, no balance sheet shrinkage coming in from the European Union. I mean, out here when you are having a WPI and a CPI number well below the RBI trajectory, you're looking at a rate cut situation rather than a rate rise situation. So what I'm trying to say is that interest rate cycle for the moment may look slightly toppish. In that sort of an environment, money flows from developed markets to emerging markets. And emerging markets are to be bought when there is chaos all around, right? And there is chaos around all emerging markets in 2018. One would have to figure out who has fallen more. Now, in this sort of an environment, you know, when so much of domestic capital has flown into the large cap space, and so much of domestic capital has been taken out of the mid and the small cap space, if one is talking about a revival in corporate profits, you know, and 50% of corporate profits roughly is represented through the Nifty 50 stocks, but the balance 50% is also represented through the broader markets, and they have seen a massive correction. The small cap index itself is down some 30% for 2018, right? So that sort of cut with earning cycle reviving would want me to believe that there is more money on the table in the case of the mid and the small caps as opposed to the large cap. Of course, large caps, you will get your returns of something like 9, 10, 11, 12% types, right? You know, and everything has been priced in, let's say, for the next 1-2 years. In most of the large cap, there's nothing called cheap in markets in the large cap space, no matter what sector you're talking about, whether it be consumer, whether it be private sector banks, etc. You know, of course, you know, the metals, the broken down sectors, one would really have to take a call and to where in the cycle. But there's value across the table in the mid and the small cap space. One needs only slight courage to put money out here, but there's greater comfort in mind when it comes to large cap investing, and not so much so in the case of mid and small cap investing. There's a whole lot of passivization that is happening in the large cap space. Of course, if that be the case, then how is one supposed to generate an alpha? It will come in the mid and the small cap space. So that is the area to focus on in 2019.
Okay, good to hear that. Great chatting with you today, Manish. Thanks so much for taking the time out and speaking with us.
Thank you.